The Consumer Bankers Association is pleased to welcome you to today's webinar, Home Equity Lending 2015 vs. 2025, A Decade of Evolution, Déjà Vu, or Stagnation, presented by Curinos. My name is Isabella and it is my pleasure to facilitate today's event. Thank you for joining. Please note we are recording and all participant lines are muted. If you have any trouble, please email conferences@consumerbankers.com or send a message in the Q&A box. This presentation will last up to 60 minutes and will include question and answer opportunities at the end. You may submit a question at any time by entering the questions into the Q&A box on the bottom of your screen. As a reminder, the views expressed in this webinar are those of the presenters and do not represent the views of CBA or its members. It is now my pleasure to introduce our speakers, Rich Martin, SVP of Retail Lending at Curinos, Ken Flaherty, Senior Manager Retail Lending at Curinos, and Kinley Hicks, Senior Associate of Retail Lending at Curinos. Rich, Ken, and Kinley, welcome.
Thanks, Isabella, for having us. Thanks to CBA, and thanks to everybody on the phone for joining. Really excited about today's topic. We'll jump in here, Isabella. But yeah, looking at home lending, we know a lot has changed, perhaps, or has stayed the same. And we've seen this movie before, as the title implied. So hopefully by the end, we'll kind of get a sense for where the audience feels. Many of you probably have been in the space the last decade or so. So certainly excited to be here and talk through. Before we get into the presentation, a little bit about Curinos. Many of you I know are current customers of ours, but we're widespread in the lending space. So not only in home equity, but we also cover solutions across first mortgage, unsecured, small business. And so today's topic, of course, be centric to home equity, but really have a true holistic view on lending, all the different types of lending that are done out there. We partner with roughly 85% of the top 100 US banks and credit unions. And specific to home equity, 20 of the top 25 home equity lenders. Probably the proudest statistic we have on our side, we've been in this market for 2+ decades, and since inception retained 90% of clients. So again, folks that come into the Curinos ecosystem, great track record with those that work with us, both myself, Ken and Kinley on the call, as well as many of our other Curinos colleagues. Unique for us when we think about it, right? And if we go back to 2015, we've continued to scale. We've continued to grow at Curinos. Back in 2015, we were a bank-only consortia. Today, we have, as I mentioned, the earlier statistic, we have credit unions, we have new entrants, fintechs, non-banks. Really expanded that kind of composition of the overall consortia, and something we're obviously very proud of on our side. From a data perspective, we're a data and insights company. We've gone from mainly a web-based kind of mode of access for customers to now delivering CSVs, PDFs, direct database access through some API connectivity as well. So really, in our evolution of the business, continue to scale. So really, you'll see that inherent in some of these views, where we started versus where we are today. Couple topical areas about us. So again, the data that we ingest on our side, clients we work with, quite a few critical areas. Really at Curinos, we're focused on helping our clients navigate today, anticipate and prepare for tomorrow, right? What's coming, near term, medium term, long term. But these are really kind of 5 topical areas where we're focused with customers today. Insights and data around pricing and fees, what's your go-to-market price position, what fees are being charged. We know in home equity, origination fees now coming into the market being charged, having transparency to that, how it changes, how are rates set, reset daily, weekly, monthly. Then we get a bit into our benchmarking core services, both on origination and portfolio. So not just what you're booking today in terms of origination flow, but also how those assets perform over time. And so you'll see with a lot of the data that we surface up today, vintages going back to the early 2000s to now, but things such as delinquency rates, utilization rates, balance growth, those types of key metrics, again, giving you that full suite and kind of diagnostics of your business and where clients like to measure, ultimately, am I winning in today's market? And then on the far right end, you'll see price optimization, so full scale price optimization, where we work with clients both in strategic support and commercial solutions, optimizing that position, right? Where can I maximize that volume and kind of rate trade-off, right? And then end-to-end suite, we do, as I mentioned, do some retained support advisory services as well for customers. So jumping into the agenda before I turn it over to Ken. Again, we want to look over the last decade in focus. Probably ask yourselves, why are we focused just on the last decade? As most on the phone probably know, 2015 was the kind of the last big year, if you will, for home equity, where we saw a lot of robust growth. We thought comparing it to what we're going to see going into this year, again, what's changed, what's stayed the same, would be kind of the main focus of it. But we're going to look, as we always do at Curinos, give a little bit of an economic summary. So look at some of the macro conditions that are out there. It kind of a wait and see, right? Or what is that telling us? How does it influence rates? How does it influence credit appetite, et cetera? We'll look at the competitive landscape. We know a lot has changed with who's new to the space, re-entering the space, double down on the space. We'll get a sense of originations and operations. So how much volume is out there? What do we see from a growth trajectory into 2025? Operations is critically important because, as we know, the customer experience has changed. Things are more or less digital now. We're seeing speed and convenience matter beyond just rate. We'll get into portfolio performance a little bit as well. How is home equity performing? It's a strong asset class. We continue to see it perform very well at various vintages, but we'll get into little specifics there on that portfolio performance. And then hopefully Ed take us home in, okay, given all of this, what do we expect for the next 10 years? So when we come back in 2035, what'll be kind of that conversation? And again, are we going to see more of the same, or are we going to see a complete change in terms of the home equity landscape? So with that, I'll turn it over to you, Ken.
Great. Thanks, Rich. Good to have everybody on the call. So this is the point in our webinar where I pretend to be an economist. So we're going to do our best job. But really, to be serious, it's going to be really helpful to kind of set the landscape of where we've been, where we are today, where we think we're going, of market conditions that'll really help set up some of the additional views that Rich and Kinley discuss further in the webinar. A lot of you have probably seen this before, but these are really the macro data points in which we consider as highly correlated with the conditions of the home equity market. So just going to touch on a few of these. On the top there, we kind of consider these more as tailwinds. On the bottom, more as headwinds. What's going to be challenges? We could probably debate on whether they're in the right category of tailwinds or headwinds. But these are generally the factors that we think really challenge the home equity market or really provide the sufficient tailwinds to make it more of a lucrative home equity growth type of market. So to touch on a few of these, we think about the unemployment. We continue to get some good performance out of the employment market. There is probably more uncertainty as to what we see out there right now as to what the future holds, but we're still holding relatively strong. And I think that's keeping consumers confident. That's keeping a lot of home equity lenders very confident on the health of their portfolios, and they continue to perform relatively well. And it's largely because of that strong unemployment number that we continue to see every single month. I'm going to take us down to the bottom middle and think of this as this is also a challenge from a headwind standpoint, because the one thing that's going to be different if we actually see some ticks up in the unemployment number is if that happens, we're going to be at a point in history that we haven't really had that much before, which is an increase in unemployment tailored with pretty much the lowest household savings rates that we've seen in 2+ decades. Makes this a much more challenging environment for home equity lenders to continue to have their foot down on the gas pedal saying, yes, we're all in on home equity, when we could very well start to see some cracks in the performance, given your dollar's not going as far, salary levels are not keeping up the pace of inflation and that consumer price index that we'll talk about on the right here. But as soon as consumers start to face some of these financial challenges within their household as a result of unemployment, there's just not as much of a cushion to fall back on. So we're kind of keeping an eye on both of these. Is we don't have to wait for unemployment to go to 5. 5's a scary number. It's more of what happens when we get to 4.5. if we get to 4.5 and we continue in this more suppressed environment of lower household savings, that is going to impact our borrowers, your customers, your members much more meaningfully than we saw a decade or so ago when we saw higher unemployment, but household savings rates were more on the upflow at that point. On the top right, as we think about the Fed dot plot, every meeting it seems to get a little bit more fuzzy on kind of what the true outlook is. I want to focus more on where we've been versus more kind of what does the future hold, because we have to think about we think about the last 10 years where consumers were in 2015, 2016, were pretty much in a relatively flat, also lower rate environment. The last few years for majority of consumers, and you think about the bankers that are there selling your product, this is foreign territory for them. When prime hit 8.5, everyone's saying, at least that's relevant in the workforce right now, is I've never seen this before. Consumers have never seen this before. How are we going to sell this a variable rate product and a HELOC, in such kind of uncertain times with the rate environment? And then you have a lot of the older legacy folks saying this is nothing. We actually saw these, double these rates just, 2 decades ago. So it's all relative to kind of your experience and where you've been. But let's just face the facts that we're heading into more uncertain times. Perhaps we might get a little bit of rate relief, but certainly as the Board of Governors are trending right now, we're likely to get maybe 1 this year, possibly 0. There's even a small percentage we might actually see some increases later this year. For those that have seen our forecast, we're trying to take all those considerations into account to determine really what is that right step forward and how should we all be thinking about the appetite for the home equity market. To kind of, I had a similar value on the previous slide, but I think this does it justice as we think about the long-term appetite or potential for home equity growth. We got to think about, the current housing market. We got to think about the available equity that continues to be one of the driving factors of why home equity will continue to see growth over the next 12 to 24 months. And it's really a factor of 2 things that you see on the page. So in that blue line, that's going to indicate that home value index. And really since 2015, we've continued to see an upswell to that. Certainly in the last 3 to 4 years, it's had a little bit more of a steeper curvature upwards. So that's positive. The annual home price growth rate, again, going to be in the black bar. Again, we've been in positive territory since really the last number of years. So you think about both of those, we have more difficulty of getting new homeowners, new consumers into homes. It becomes more challenging on the affordability aspect. But thinking about your target audience, which is the existing homeowners, those customers are building up a wealth of equity in their homes, making it a very lucrative market for home equity lenders to provide solutions and alternatives for their financing needs. And those existing homeowners, we're going to talk about in the following page, are sitting at really good interest rates. We have suppressed real estate inventory, and we have a challenge of affordability. So all of those factors combined really paint a really nice path forward for home equity lenders to continue to drive down on home equity lending, saying, you're probably not leaving that house for a while. You probably can't afford the next house for a little bit. Let's figure out how we can spruce up this existing house, or we can make your financial situation a little bit better by doing some debt consolidation without having to touch that first mortgage. And so, as promised, here's kind of our view on what we think that rate environment needs to look like before those first mortgage lenders start to take some of that home equity cash out business. On the left-hand side, again, we mentioned this before. Again, it just really shows just the runway, the width of the runway that we have for tapping into those first mortgage holders that are probably not leaving that home for a while, while at the same time, they're going to be holding on to that first mortgage, looking for other cash out solutions through a home equity product. But we're gauging it roughly about 67%, so about 2/3 of active first mortgage holders possess a rate less than 4.5. So is 4.5% roughly the rate that we need to see for a good majority of existing homeowners to start to pivot and say, home equity may not be the best product for me? So in this chart, we're really looking at two scenarios. On the top scenario, this is saying for an existing mortgage holder, if they were to take out a $100,000 HELOC, probably need to adjust those rates given the current conditions. But if we look at what this looks like, it makes more sense in today's scenario for them to leverage a second lien HELOC or a closed-end second home equity. And then kind of doing some quick math calculations, once we get to 575, I know mortgage lenders are going to be cheering that we finally, broke the 6%. But is that enough for the majority of first mortgage holders to abandon the home equity product and do a long-term money cash out refinance and abandon that home equity product? We don't think so. We think that sweet spot is somewhere between 4 3/8 and 4.5%. It doesn't mean that it has to hit that, but that's where it's going to make the most financial sense for a lot of those homeowners that are sitting at 3 to 4% interest rates, where that's going to make the most sense. I'm really positive about our economy. I think we'll continue to thrive. There's a lot of questions out there, but if we're hitting 5 and 4% interest rates later this year, even into next year, feel like we've got bigger fish to fry. We've got other challenges if rates are dropping that quickly. And my mind tends not to go in those scenarios. I think we'll see more of a slower approach if we ever get there again over the next decade. So we're going to, before we kind of jump into the meat of some of our content today, we're going to poll the audience based upon the topic of our webinar is, how much do you think the home equity market has evolved over the last 10 years? And I want everyone to really be honest of not just thinking about your own institution if you're with a lender, just thinking about the market in general. Do we think it's truly been a decade of evolution? Does it feel like deja vu? Or is this more like stagnation? So we'll give it a few seconds here for that poll to populate and start collecting your results. For this, I have my opinion on what I think this feels like. I'm going to reserve my opinion and let the data speak for itself. But I mean, it is exciting just to think about and working with a lot of you as our clients of some of the investments that you've made in your business, specifically on the technology side, that it really does feel like it should be a decade of evolution, just making things more convenient for borrowers, letting them make more informed decisions. As Rich mentioned, at Curinos, we've evolved quite a bit from a technology standpoint, putting more data at your fingertips to make more near real-time decisions. So that's where I would love to see things, but not completely sold that it's been a complete decade of evolution. Okay, let's see here. So we did get the poll results, and it looks like this is a toss-up here. So on the decade of evolution, 32% of you said 32% said it's a decade of evolution. Right now, the winner feels like deja vu, about 41% of you, and then another 27% say it's more like stagnation. So we're neck and neck there, but feels like deja vu kind of takes the cake there for 41% of respondents. So thank you for taking that. We have 2 more poll questions staggered throughout today, but appreciate the quick responses there. Rich or Kenley, did we have any feedback in the Q&A or anything we need to address before we keep moving through the competitive landscape?
We are good on questions, but yeah, the deja vu one was interesting, Ken. I wonder how much fatigue and stress for those I joked at the beginning have been in the industry the last decade. I wonder, maybe not surprised on the deja vu leading the way, but I wonder how much fatigue and stress play into that answer. So
True, very true. Just a different stress, not the same stress. Okay, so let's talk about the competitive landscape. I had the pleasure of speaking at the Consumer Bankers Association, or CBA Live, last week, and we talked about this and got some good responses. But this is, I think, a really good depiction on where we sit right now, or at least through the end of 2024, for what the makeup looks like and the types of lenders. So on the right-hand side, this is kind of accounting for kind of the broad home equity products and types of lenders that are out there right now. Positive news here is depositories, so this is going to be banks and credit unions, still own the market, own about 80%. Fintechs, or the non-traditionals, own about 15%. And to kind of our best guesstimate based upon some desk research, HEI, which is the home equity investment product, makes up about 5%, maybe a little bit south of that. But we say still pretty conclusively that depositories own about 15%, or sorry, 80% of that market. What I want to stress here is this number looked very different a couple of years ago, where depositories owned virtually 100% of the market, really less than 5 to 6 years ago. So as kind of Rich mentioned at the top, one thing that we're going to continue hitting on throughout today's discussion is this is going to continue to evolve. With only 5 or 6 years and now non-traditional lenders now making up 15% of this market, they're not going to be content with 15% of the market. And they're going to see how much more can I eat into this 80% of depository share by making things faster, simpler for the consumer to evolve to their product, which essentially is the same product they're selling, that you're selling. It's just being positioned a little bit differently. So let's talk about that, on how the products differ between depositories and some of the non-traditional fintech type lenders. So really the main point to deliver here, which is why it's highlighted, is at the end of the day, a lot of non-traditional lenders are not reinventing the playbook in terms of product lineup. As what's mentioned here, depositories and non-traditional lenders are still using the core products of home equity lines of credit and closed-end home equity loans. So there's variations on how the product's positioned, which is kind of highlighted in the second column, meaning whether there's draw requirements, the draw periods, so that you're going to see very different by type of lender and type of specific institutions. But at the end of the day, it's still the core product that's being sold to these consumers. So when we talk about, what's déjà vu, what's stagnation, from a product standpoint, it's déjà vu. Nothing's really changed. What has evolved over the last decade is kind of these non-traditionals, as I mentioned, now take about 15% of the market, that are now positioning products to borrowers kind of on the box of, we can do things faster, we can do things easier, you can have your money in just a handful of days, but it's not coming with all the perks that a bank is traditionally delivering, which is kind of a draw on demand type of HELOC, minimal to zero fees, as compared to kind of this pay for convenience. We can get your money faster, we can get you through the process more efficiently, but there's generally going to be fees associated with it. So I know even last week, I know Kinley and I having conversations with many of you, you scratch your head at is, why would a consumer go to a non-depository or a fintech lender when they can come to where they actually have their deposits, get the same product at a better price, at possibly zero fees, and have a longer draw period for that draw on demand function? We're not here to answer that question for you. There's probably lots of reasons why consumers would do that, but throughout today, we're really trying to drive home of what makes the competitive environment different, and really things that Rich will wrap up on is things that you can take away today to ensure that we're continuing to evolve and continue to stay relevant in this evolving home equity market. So Just to double down on from the previous slide, this is really showing kind of a good excerpt of, what has the product evolution or total product distribution, how has that looked over the last several years? Again, I would kind of reference this as very much of just a deja vu. We're driving different products to a different degree over periods of time, but essentially, as I mentioned before, just haven't had a true evolvement of the types of home equity products. So if we look here on the legends, we think about HELOCs, or just have always, historical to present, been the main driver of the chosen home equity product. So we think about it's an easier product to sell. Bankers understand it, just easier to gravitate to, comes with more payment flexibility, so on and so forth. So historically, it's always taken up anywhere between 75 and 85% of the total market distribution. It just depends on the rate environment, depends on the payment sensitivity of borrowers and the conditions of that consumers are in, is really when those home equity loan products start to gravitate to a higher distribution. But in the grand scheme of things, about 20% is generally the max that we've seen over time of when that product is positioned. And HELOCs are still winning out majority of the time, anywhere between 80 to 90% of total originations. So let's keep going. I'm going to hand it over to Kinley. Kinley is going to walk us through kind of with this in mind of kind of the competitive landscape of really diving into some specific views on originations and operations. Let me just take a quick pause for just a quick Q&A. Rich or Kinley, anything in the chat that we need to address before we turn it over to Kinley?
Yeah, we had one, Ken, if you go back a slide, I think on those last bar charts, there was a question just on the 59%, the 59% number, sorry, for 2024 for second lien HELOCs. Is that inclusive of some of those non-traditional players requiring that full draw?
Great question. No, this would specifically be referring to the depository lender. So we'll be sure in some of these slides to specifically call out if we're comparing depository to non-depository or fintechs, but in this specific view, this is going to be depository lenders only.
Great.
All right, Kinley, originations and operations over the last decade.
Awesome. Well, if we want to jump into it, the first slide, just very high level, looking at HELOC originations trends, benchmark to 2015. So the way to look at this is holding 2015 as the constant. How have dollars and units trended comparatively year over year? So if you look 2016, 2017, both of those years saw slight 10 to 15% increases depending on units or dollars compared to 2015. But if you look farther along that trend, as we're hitting 2020, 2021, including 23 and 24, outside of the blip up in 2022, where we did see some positive growth on those dollars. We are slightly down. If we're looking at the dollars, about 29% down for 24 compared to those 2015 numbers. If you look at the units, it's down slightly more so than that. And as we will see in the next couple of slides, the volume is slightly lower or slightly less declines year over year, slightly just because higher line sizes are continuing to book as we see increases in home prices and overall HPIs.
And before we move on, for anyone that attended our webinar last fall, we talked about this, so we weren't going to spend too much time on it today, but I kind of look at 15 and 16 as sort of cheating. It's probably a bad way to say it, but you have to remember what happened in 15, 16. That was our industry's first big wave of end of draws when a lot of lenders converted off of the balloon in 2005, 2006. So a lot of that 15, 16 activity that we're comparing against was the result of, it was almost 22% churn of customers hitting end of draw that all of you were calling to make sure that that customer re-upped for a new HELOC. So keep that in mind of we're coming from kind of an inflated number during that time frame.
Yeah, I think back on the topic of deja vu, stagnation, if we pay attention to overall credit originations characteristics, really you can see on the page there's really not much of a difference. 2015 average booked credit score was 783, 2024 785, about a 2-point increase in overall credit score compared to 2015. But overall, I would agree, probably deja vu. Everything is holding pretty flat on those average credit scores. CLTVs, 2015 was about 63%. If we looked at 2024, it's holding at about 60%. If you pay attention to the page, as I kind of alluded to on the previous, looking at dollar change year over year, the main shift that we are seeing from 2015 to present is that line size. In 2015, we were averaging just under 120,000 as your average line size. If you look at 2024, just over 9-10 years, we've jumped up to 150 as that average booked line size. We'll look at a median, and a couple of pages medians are even higher. But if we're paying attention to average line sizes, we're seeing massive growth in overall line sizes, while everything else is sitting pretty flat to consistent year over year. And I think as we talk about vintages hitting end of draw, you think about that 2015 vintage almost hitting that 10-year end of draw. So just looking at portfolio performance by vintage year as of 2025, so those 15, 16, 17 vintages still make up about 13% of all active balances, about 20% of all commitments. And if you look at the utilization rates, current utilization rates are still sitting about 20, 23, depending on the vintage year, 2015, 2016, 23% utilized. 2024 vintage about 40% utilized. But back on the point of deja vu, if you look at that initial utilization rate, nothing's really changed. That 2015 vintage sitting very mid 30s, low 40s in that average initial utilization rate. 2024 looks almost identical, about 36% initial utilization rate. So we really haven't seen much of a change on those initial utilization rates from 2015 to present. So over the past 10 years, there hasn't been much shift in getting people to take more or less of the utilization. But we have seen as average balances go up a little bit, just because we see those average line size continue to grow from about 124,000 in 2015 to about 150 in 2024. And I think final point, just paying attention to portfolio. If you look on the left side, unit distribution by utilization tier, I think it's expected that some of those units that are hitting their draw period, their 10-year draw period, are going to be sitting at less than 1% or 0% utilization. What's surprising, though, is it's only 54%. We still have nearly 50% of all the balances of all those units are still utilized. So as Ken was talking about the first wave, we're hopefully maybe starting to see that 2015 hitting 2025. We still have about 50% of those units more than 1% utilized. You even have some 7%, 95% utilized, 14% more than 60% utilized. So you still have a lot of utilization sitting in those 2015, 2016 vintages. Yeah, and if you, sorry. Yeah, one last call, just paying attention to the median credit score for these vintages of the units that are still active. So not including the ones that have paid down and closed, they're still sitting at about 780. So no credit deterioration. It's all sitting still very healthy credit score ranges. So that was the story of what's kind of held constant. We haven't really seen much of a shift. So what have we seen change? Well, if we look at on the origination side, HELOC booked unit distribution, 2015, I think you see 79%, 80% of those units were coming in through the branch, only 5% in the web. So a very small amount, about 15% coming in through the call center, but that held pretty constant through 2019. You see 2020, a little bit of growth, about 12% in that web. But if you pay attention, the broad trend from 2015 to 2025, you can see that web distribution has grown to nearly a quarter of all units. So it's gone in just 10 years from about 5% of all booked units to about 25% of booked units. We've also seen a good growth in that call center distribution, about 25%, and it's all been at the detriment of the branches. So they went from 80% of overall booked unit distribution in 2015 to about 52% in 2025. So there has been some shift as we're paying attention to what's changed, what has not changed. Sub-channels are seeing some shift. We're starting to see folks embrace the digital sub-channels.
So one quick addition that I'll make here is, you know, we have a working theory here at Curinos that we're trying to get some more seasoned data to establish. But as Kinley mentioned, you know, over the last few years, we're really lessening our reliance on branch bankers to be able to, you know, hit our budget numbers, which I think is smart. Is bankers wear a lot of hats. You get their focus maybe a couple times a year. How can you kind of pivot and have more of an online presence for the convenience, but also you can have things more always on, where you have more consistent flow. So the COVID years didn't really help us there make any true observations. But you know, the piece that we're really looking at is now that we're almost about a 50-50 mix on branch versus non-branch originations, does this help address some of the huge influences that we have seen in seasonality? Meaning, you know, when I was sitting on the bank side, you kind of crawled under a rock in Q4, didn't crawl out until Q2 because Q4 and Q1 were just arguably the most challenging environments, especially here in the Midwest. Everything's cold. Nobody's thinking about home improvements. But the fact of consumers still need money, they still need debt consolidation. So if the activities aren't happening in the branch, as long as you're having that flow of activity and having an option to meet those customer needs during some of the off-peak times of the year, like Q4 and Q1, whether it's through your call center or web, just our hope is the data will help spell out for us that we're shrinking the impact of seasonality, given that you're just not always reliant on people walking into a branch to be able to start that transaction.
Yeah, and I saw a question come in just on the initial utilization timeframe, and just for context on that, initial utilization, initial balances is going to be first 90 days on book. So this is tracking overall average cycle time by product and reporting year. So that black line is going to be those HELOCs, and then the blue line is going to be looking at HELoans. So tracking overall average cycle times. And as we've seen sort of that movement into more of a web-based sub-channel, a call center sub-channel, we have seen some good movement in overall cycle times, averaging about 52 days in 2015, down to about 41 days in 2024. So we've seen about 11 days of improvement, but I think everybody, you see 41 days up to 44 days, depending on the product in 2024, and it's still a bit of a head scratcher. Why are these units taking 40 plus days to overall from application to booking cycle out? And so here you can see left side is going to be HELOCs, right side is going to be HELoans. And this breaks it out by your application to final approval in that gray bar and your final approval to booking in that blue bar. And so if you tracked from 2015 to 2015, looking at both, but we'll focus specifically on the HELOCs on the left side, what you can see is there have been improvements on the lender side on those app to final approvals, hitting about 30 days in 2015, 2016 timeframe. And on the controllables that you most definitely can control, you have seen improvements down to about 21 days in 2024, about 19 days in 2025. So seeing about a 10-day improvement, as we saw on the previous slide, overall 10-day improvements, here you can see those improvements are coming from the app to final approval stage. On the flip side, where we're seeing a flatlining, where it's really not seeing much improvement, is that final approval to book. So after you final approved that HELOC, we're still seeing about 20 days it takes to get from final approval to booking. So about 3 weeks, if you look in 2025, it's taking the same amount of time to get to from final approval to booking as it is to get from application to final approval. So as we do see some improvements on one side of the spectrum, we're also not seeing improvements on the other side. And then this is specific to pull through. So that top one's going to be HELOC. The blue line, similar to cycle time, is going to be HELoans. So we really haven't seen much of a shift in HELOC pull through. So if we're looking at that black line, 43% in 2025, about 44% in 2024, not much of a shift in pull through. So even with those 10-day improvements in cycle time, the average pull through has not really shown much of a shift, still sitting at about 44%. So as we talk about what's changed, what has not changed. Overall pull through has really not seen much of an improvement or degradation either. Cool. So we'll hit you with one more poll question for this section. So what is the fundamental reason, in y'all's perspective, why cycle times have shown little to no improvement over the last decade? So a lot of options. Just pick your most favorite one. So lack of technology integration, digital front ends still paired with manual fulfillment and closing processes, lack of differentiated workflows, regulatory challenges, banker influence / availability on closing an office, or feel free to write in another your personal perspective.
Yeah, and if you do select F on other, as Kenley said, just use the Q&A box so we can know what those others are.
Starting to wonder after the last section, we should have re-pulled the first question. I wonder if the deja vu contingency would have increased after looking at some of those slides. It was very much bent towards not much has changed, but
That's where I was leaning, Rich. I didn't want to influence anybody's responses there. I have my opinion, but we'll let the data speak for itself.
we should clarify that panelists or hosts cannot vote, so we are not included in those
Right.
those final figures or numbers.
All right, I think we can wrap that poll. Kenley, you want to read out the results here?
Yeah, I think it's a bit of a mixed bag, but it looks like digital front ends still paired with manual fulfillment and closing processes is the winner with about 41% of the total respondent pool. Lack of technology integration comes in second place, and then regulatory challenges come in third.
And it looks like we do have a question in the chat. So are we seeing any evidence that lenders are using FedNow or real-time payments by the clearinghouse to deliver loan proceeds? Also, can you put the pull-through chart up again for a moment? Sure. And I believe Isabel, I believe the CBA will also be sending a copy of the material as well within the next 1 to 2 days.
Correct. Yeah.
Perfect, thank you. So for the person that requested, here's the pull through. To answer your question, we've had a lot of conversations with some clients on that. To our understanding, based on who we work with, we do not know of a single lender that's leveraging FedNow or any sort of real-time payments through clearinghouses to deliver loan proceeds. All right, let's kind
I
of.
think that covers originations and operations. So I'll pass it back to you for portfolio.
Great, thanks, Kenley. So I want to move quickly through here and then pass it back to Rich, because I really want to spend some time on, we've seen a lot of data. We've kind of all made up our minds. It's been more deja vu more than anything. But in really, how do we break out of deja vu and stagnation, actually move towards evolution within our market? So real quick, leveraging our proprietary data where we collect monthly portfolio snapshots from a number of lenders from their portfolio servicing. So now we're looking at by month on book. So we see a snapshot every month of every single loan within those portfolios that's then aggregated. So we can follow these loans every single month to see how they perform. And really, as we think about the different vintage years, we're looking at 15, 16, 19, 20, and then 23, 24. That's all color coded there. So really what we're looking for is, are any years performing any differently, historical to present? What should we consider as, are customers performing differently because we're influencing things, as Kenley showed before, with higher line sizes, but similar average balances? Are customers' pay down speeds performing any differently? So really what we're looking for here, so we compare more recent vintages in 23, 24, we start off much, much lower. And I think this is largely the result of line sizes outpacing the needs of borrowers. So we're starting at a lower start point. We start to make our way towards, 2015, 2016. These tails on the end are unseasoned. That's really just like 1 or 2 months vintages within those portfolios that are kind of dragging the lines upward here. So we're seeing something a little bit more positive, appears to be a little bit more flatter in that 23, 24, but our concern is our start point. We're having to work uphill a lot harder from the start of when that loan originates. As compared to 2015, and then we'll look at 2019. Again, it's nothing impressive. We're moving from about sub 30% to about 34 and then 38%. But 30 to 38% is a pretty sizable difference in, the total optimization of your portfolio and what's being left unutilized. It's creating those servicing expenses in your portfolio. And then really we look for the longer trends, and we're not seeing anything too out of the ordinary. 2019 just had a lower start point and just kind of had a lower overall performance. It seems to be improving a little bit, which is uncharacteristic. And we think a lot of what we're seeing right here is the result of some of the improvements in rate that a lot of those borrowers, or all of those borrowers, originated at probably a 3-handle HELOC. And then over a number of years, now they're sitting at an 8-handle HELOC because of the variable rate. So perhaps we're kind of hitting into more of the payment and rate sensitivity aspect of these borrowers of, hey, show me that 3% rate again. I need this money, but I'm not willing to, be charged 8% given the variable nature of this HELOC. And then as we think about some of the delinquency trends, as Kinley showed before, our credit box and the credit appetite and who we're originating to hasn't really evolved that much. It's mainly to 780 plus borrowers. And so as a result, I wouldn't expect anything to change. So this is good news. We're not seeing credit score tranche borrowers perform any differently, meaning we're not seeing less than 700 borrowers show increased risk, and we're not 780 borrowers start to perform like 680 borrowers. This is extremely consistent over a period of time, really since a lot of that credit normalized after 14, 15. 16, we've really been even in total performance. So this is probably the only slide that we're okay with deja vu, or we're okay with nothing evolving, because we're already sitting at fairly low delinquency rates. And sure, we've seen a little bit of pops in delinquency here and there, but from a credit score hierarchy, this is exactly what you would expect, and really don't see any surprises here. And to add to that, the last piece of this is, okay, so we're not seeing that borrowers are becoming more or less of a risk based upon their credit score profile. Are we seeing just more delinquencies as a result? Are we seeing the likelihood of borrowers becoming more severely delinquent in some of these 120 day or greater buckets? The culmination here is not really. We're seeing a little bit of help here in the last few years, where it appears borrowers are just becoming more slow pay borrowers. They're not resulting in charge-offs. So this is really good news here. Is what we saw in 15. We saw a large influence of borrowers weren't just being slow pays, or being slow pays and then resulting in charge-offs. Saw a little bit of that in 2021 creep back up, but I think there was more explainable reasons. But since 21, we've continued to bring that back down, similar to what we saw in 16, 17, of more of a presence of slow payments and less a result of customers getting severely delinquent that were likely resulting in charge-offs. So with that said, we have one more poll question for you. Rich, I'll let you handle our last one here.
Yeah. All right, so lower sustained delinquency, as we saw in those trends, is mainly the result of minimal changes in credit risk offerings. So we think of that as buy box. Buy box hasn't changed. So we continue to see this particular collateral perform well. Improve home equity ownership, too much to lose. We know folks have more equity than they've ever had before. Regulation and oversight, stress debt to income, ability to repay. We know there have been changes in the last decade or so on the tax deduction side. That's set to expire this year, right? That could be a huge growth opportunity for home equity. And then ATR, ability to repay from some of the Dodd-Frank legislation. And then lastly, borrowers simply not using HELOCs the same way today as they were 10 years ago. We'll see. This might be the first one, maybe where we have a little bit more broader consensus, but we'll wait for those to trickle in.
Then, Stephen, I see your follow-up question in the chat. As soon as we wrap up our last poll here, we'll jump back to your question there. Great, Isabella, I think we can wrap that poll.
Still okay. Similar, I think, distribution to the first poll question. So about 40% minimal changes in credit risk offerings. What we sort of saw on one of the earlier slides that Kinley was presenting, more or less status quo there. 27% due to improved home equity ownership or equity position. And then a third in terms of regulatory oversight. Interestingly, no one on how borrowers are using HELOCs today versus 10 years ago. We might have a different opinion, but hey, those are the results. So Ken, do you want to take the Stephen's question in the chat, and then I can wrap things up?
Yeah. So question came in on, is there still a capital burden on unused HELOC credit lines? 100% yes. Does it impact banks of all sizes, credit unions too? So I think it's just in a series, yes, yes, and yes. In particular, what is in the minds of a lot of you, especially from the larger depositories, specifically banks, is Basel III endgame of will that come to fruition? And if so, there is a sizable change proposed that will impact HELOC lenders, and that unused line where there's going to be more of a risk-based capital charge. So lenders are going to be going to have to look at this a bit more microscopically and understanding based upon the risk of that borrower and that unused line portion, there could potentially be an even larger capital charge on those unused lines. So something that I know many of you are thinking about kind of in the back of your mind. We held a home equity forum for our clients in December of last year. And if memory serves, I believe, unless anything changes, I believe that Basel III endgame requirement goes into effect in early 2027. So we're less than 2 years away of that potentially for a lot of you being a material impact on this idea of trying to get borrowers to use the line at the time of origination and trying to minimize as much as possible that unused line to maintain lifetime profitability on that line of credit. Okay, Rich, we'll kind of fast forward here and see what can everybody on the call take away and ensure we have the evolution over the next decade.
You bet. Thanks, Ken. Yeah, I think we'll got an interesting kind of rhetorical question at the end, but I think as we focus right in takeaways from today, there has been some evolution. I think many of the performance trends or proprietary data we had illustrated more of kind of a status quo. But I go back to one of Ken's earlier comments when we were kind of illustrating the competitive landscape. We have seen evolution there that has shifted dramatically. That market's become fragmented with entrance of the fintechs and some of the IMB or non-bank lenders. That market share statistic I think was most compelling. 2% 5 years ago, and last year making up roughly 15%, right? And that's just in the last 5 years. But we know with that increased competition and evolution, it's challenging the status quo of traditional depository strategies or credit union strategies and acquisition models, cross-selling to customers. But it really kind of blends into sort of 3 core areas we think for us is you have to have that evolution with borrower needs, right? We hinted at it in some of the poll questions, but we're borrowers today. We know it's not just a rate equation or a rate paradigm for customers. Speed and convenience matter. Faster, easier, more intuitive, the ability to reduce that friction or those points of friction in the process, kind of what we think is traditional banking. The folks that we see winning, the clients we talk to, we see winning, are constantly evolving what those borrower needs. Borrowers establishing intent, understanding your customer at the end of the day, right, and approaching it with the right product at the right time, and really through the right segmentation. Process easier. We know that digital transformation we talked about earlier, everything being digital, is going to hyper personalized. Digital is going to make that process easier for borrowers. We see borrowers paying a premium. We know there's a premium being paid with the new entrants for that easier, more intuitive process, and borrowers continuing to demand those features, right? Especially as we think about the new next kind of wave of household formation, both for mortgage and home equity. Digital is going to matter. And then, a little bit in terms of data-backed decisions, you famously can't manage what you can't measure. Is having diagnostics, having data insights into your business, how you're performing relative to the market, something we excel at Curinos, across all facets of lending, but particular home equity. What we've seen play out in the last 10 years, again, what we expect, some of these themes as we go into the next 10 years. But I would say we expect, I think, a bit more evolution than what we've seen. Ken or Kinley, anything to add to that before I move to the next slide here and kind of leave the audience with a little bit of a history lesson?
I think your statement there on evolve with borrower needs really summarizes the next slide on why, if you've tuned out for this entire webinar, the next 30 seconds are probably the most important. So stay tuned here.
So we'll leave you with this. This is kind of maybe a rhetorical question, or certainly a case study, right? Of ultimately, going back to maybe deja vu a bit. We've seen this story before. History, as we know, has a tendency to repeat itself. But if we look at the other side of the balance sheet on the deposit side, looking at 2019 versus 2022 here, the advent of direct neobanks kind of entering the deposit space. You've seen that market share growth from 30% or 33%, I guess, 30% in the band in 2019, up to now almost 40%. That's rise of Chime and Vero and some of these new neobanks coming into the marketplace. I leave you with, will history repeat itself again? We've seen this trend continue. We've seen these neobanks kind of tailor their offerings to specific customer segments. Again, eliminating that friction of traditional banking, emphasizing really in transparency, digital financial inclusion, all of this to kind of build that sort of customer trust, if you will, out there in the marketplace. But we have seen this before in deposits. Like I said, we're continuing to see that play out. Will we reach the same kind of trajectory in home equity? I guess maybe that'll be the part 2 of our webinar here, but I think it's just something we wanted to leave the audience with and considering. We have seen it before. We've seen it in the deposit segment. And again, what will home equity look like in another 5 to 10 years? Will we see ultimately history repeat itself? Last slide, Isabella, if you can just advance one. I know we're just about top of the hour. Want to thank everybody. Want to thank CBA for hosting our webinar. I always love the opportunity and chance to get in front of CBA and the audience, and appreciate everybody's time today. As Ken mentioned, we'll plan to distribute the deck here in the next day or two, and feel free, come reach out to myself, Ken Kinley on the Curinos side. Would love to talk to you about, again, what we're seeing in the home equity space, a bit more of our outlook, but really enjoyed today's session and appreciate everybody attending.
Thanks so much, Rich. And thank you, Ken and Kinley, for joining us as well. Really appreciate everyone taking time out of their day to join us here on the webinar today. I will be distributing the deck as well as the recording and other information following this, either this evening or tomorrow morning. With that, we will conclude today's program. Again, thank you to our speakers and everyone who joined us today. On behalf of CBA, thank you for joining us. Have a great afternoon. You may now disconnect.
So